Good morning and welcome to a new year and the first Post-Monetary Policy Committee press briefing of 2023. The Monetary Policy Committee of the Central Bank of Kenya held its meeting yesterday and did send out its press release. And as is customary, we now have a press briefing that will be hosted by the Governor of the Central Bank of Kenya to give a background of that meeting and the decisions made thereof. As we usually do, the Governor will speak through the entire presentation, after which we are able to take questions from you. We will be taking your questions through the Slido app. That's www.slido.com. The meeting is #MPC0123. So without further ado, I'd like to introduce the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Thank you very much, and good morning. Welcome, all of you. And before starting the main business of the day, I want to wish you and your families a safe and prosperous 2023. The Monetary Policy Committee met yesterday to assess developments since its last meeting in November 2022. You'll already have seen the press release. And this briefing, I will give you additional background information to give you the context of the decision. As we always do, we start with the global developments. And the world is battling many crises, and no two economies are alike. And at this moment, the jargon that is out there is polycrisis. And this is especially the case, that is the disparity of countries is especially the case with regard to the risks that they face. The COVID pandemic is now in the rearview mirror, but most important development in this space is the reopening or the opening up in China. So now we have better assurance in terms of production, supply chains, because China is back on stream, as it were. Of course, there are risks for a resurgence of infections, and obviously the various economies and various professionals are watching that space carefully. Then the war in Ukraine, it lingers on with risks of further escalation. However, the winter in Europe has been relatively mild, at least more than had been expected. And therefore, the energy crisis that appeared almost certain has been deflated. Inflation in advanced economies has reached a turning point, declining in recent months, though still high. And you can see that chart, the various countries. You have UK at the top, then followed by Eurozone, then the US, and China at the bottom. India, the green, and China at the bottom. And you can see the inflection points for those outcomes, inflation outcomes. Nevertheless, the numbers are still high, way above, let's say, the 2% level that the advanced economies generally target. Then international prices of oil have moderated, and you have that chart there. You can see towards the end, we have 80, I can hardly read it. That for this year, it's 84.8. And we expect that the price of oil will hover around there, $80, $85 per barrel. And this compares to the average of about 100. Actually, for 2022, it was 98.6. And we had actually worked our numbers with an average price of $100 a barrel. So that's quite close. But the point here is that it has moderated the price of crude oil, and even as there's still volatility in that market. Global commodity prices have also declined, and that's a chart that we have seen And I think the first one is palm oil. You can see the green. It had surged dramatically to a peak of about 1,700 US dollars per metric ton. And now it has moderated to about 940. Still higher than 2020, but definitely lower than 2021. So on the whole, this has improved. Supply chain disruptions are also easing, and here's a graph that we have looked at before, the cost of moving a 40-foot container. And you can see the peak in September 2021, and it has come down more or less to where it was in November of 2020, which in a sense signals the dissipation of those supply chain problems that we had before. Then, of course, the central banks in the advanced economies have been hiking interest rates aggressively. And there's less need, therefore, for increases that they had telegraphed that they were going to have into the future. And the reason for that is largely because inflation outcomes, as I mentioned before, in those economies are coming down. The global financial markets also have eased, but admittedly, we are only in January. So we need to keep watching this space. So again, it's this background. The MPC looked at the revised global growth, and the world, as of yesterday, when we had been looking at the MPC met, we did not have the IMF numbers. We actually had the World Bank projections, and actually those came out last night, the IMF numbers, and they are quite aligned. So I will not discuss the World Bank projections, even though that's what the MPC based its decisions on, because it's quite aligned, and we have in the past been looking at the IMF numbers, so you are more familiar with those numbers. Bottom line, though, is that the global economic activity is expected to slow down in 2023 and then improve moderately in 2024. So the IMF numbers are the ones that have been shown there. They were released last night. And I think the ones to look at is the US numbers. You can see the US numbers have been revised up for 2023. And also an interesting, and that obviously brings global growth up. Russia has been revised up also by about 2.6 percentage points. That is for 2023. But the one that I think is worth flagging, really, spending a little more, is China. If you look at China, which, as we all know, has been growing quite steadily, you have the growth in 2021, China was 8.4. Then last year, 2022, came down to 3%. It's amazing that actually they were growing at below average of the global growth. Global growth last year is estimated at 3.4. You know, this is unheard of, and this is a major difference in outcomes last year. But you can see now or at least the IMF expect the economy to grow by 5.2, an upward revision of about 0.8 basis points. You can look also at euro area, etc. Now, of course, we have put in Kenya there because they also projected Kenya. That's the IMF in the WEU, in the World Economic Review, World Economic Outlook. But clearly, we have better numbers, which we are going to discuss in a minute. So, what's the bottom line? The bottom line here is what I just mentioned, that the expectation that there will be a slowdown in 2023, as indicated there, and then sort of a moderate improving or strengthening moderately in 2024. So we expect the global economy will see this seesaw between the fundamentals and perceptions. And then also between the markets and policymakers as they make those decisions. And all this against the risks that will materialize, all will dissipate. So it's a complicated sort of outcome. It's a somewhat of a 3D sort of move in all this. So I think these global developments are kind of more concerning because there are many more options, or not options, but many more possible outcomes looking forward in 2023. We now switch to domestic economy, and inflation has been above. Oh yes, before we go to the inflation, I thought since this is the first presentation this year to sort of take a 30,000 foot level look at our economy. This is a slide that I presented to our policymakers, our parliamentarians when I did a presentation to them. And I think it captures everything that we have in the economy. And so we have the voyage of MV Kenya, so MV Kenya. And it is being pushed by winds which relate to fiscal, sort of fiscal outcome, fiscal policy, financial outcomes, financial policy, and also the external sector. Then, of course, the dashboard, if you may, what are we looking at this is a bit like the dashboard in a car. Well, economic growth, cost of living, health, education, infrastructure. Those are things that we want to improve in and want to see on the dashboard that they're going to the plus side. There's improvement there. And then, of course, there are things that hold us back. And these are listed on the side there, on the left-hand side. Corruption, a big drain to the economy. Pending bills, which obviously is a big concern to the private sector and also to the government, both the national and the county governments. And then high inflation, clearly, that really drives the outcomes in a different way, pushes outcomes down in many ways. Weak institutions, which possibly end up not only being a drain to government, but being a terrible sort of signaling device of outcomes, etc. Poor environment, not only economic environment, but also the climate and the actual environment that we live in. All these are things that hold us back. So they appear like that anchor. And of course, we have debt. Debt is should be a stabilizing device in the economy. But of course, so there it appears like the keel of that boat. But if indeed you have too much of the keel, it will probably end up, snagging the rocks and things like that, or even capsizing the boat. So I think that is why it is there. It should be there to stabilize the voyage of the boat, but at the same time, obviously watching it. So this captures let's say, the struggles of any policymaker, or for that matter, the outcomes that any citizen in the country would look at, all on one picture. So even as we talk about GDP, etc., I wanted us to, and inflation, etc., all those economic outcomes, I thought that we could take this 30,000 foot and deal with it. So now we move to the inflation, which has been above 7.5% since June. But the central bank has taken various action in May, September, and November. And we have actually also explained, at least in November, we did spend some time explaining why it was important to deal decisively with inflation. Now, those measures that were taken are still they do take time in terms of having effect. And, but nevertheless, the tide has turned, and you can see there the overall inflation is now, December was at 9.1%, down from 9.5 and 9.6, October 9.6, November 9.5. Obviously, we are expecting to see the January numbers sometime today when the Kenya National Bureau of Statistics releases them. So we'll see what the outcome is for January. And the other point, of course, is to realize that food is the significant driver in this. Of the 9.1 percentage points, 5.1 of that was food. And it is true. Also, fuel was 2.7 percentage points. And we also understand the dynamics of fuel. There was the subsidies that were now removed. And now we expect that the price of the domestic, let's say the pump price, the price at the pump, will track the prices in the international markets, particularly the Marban oil grade, which is the one that they generally use to do their calculations. So moving on to the next thing, as we know, there are 4 items that contribute significantly to food inflation, or in the CPI, the food CPI, or the food component of the consumer price index. And this is wheat, maize, milk, and edible oil. And you can see that has surged to a peak of 3.4 percentage points, and now it is down to 2.5 percentage points. So, and again, given what I said about various prices in the international markets, we expect that this will continue to fall. At the same time, it's important to note the significant developments around food. First, we know that the fast-growing vegetables have already hit the market following the rains in November, December, and maybe we would have expected more rain, but it is what it is, meaning sort of dry conditions pretty much across the country. But anyway, so you have the fast-growing vegetables. Secondly, we are having the long rain harvest, or rather the long rains maize harvests. That is particularly in the western part of the country and the Rift Valley. They have the long rains, that's when they plant, and this is the time they are harvesting, which will bring us through to February. So that will obviously increase supply. We'll talk about this in the agricultural survey that we mentioned, that we conducted. And then thirdly, we know about imports of duty-free, imports of maize, rice, and sugar, which have already been gazetted as to be imported duty-free in the period February 1 through August 6. Bearing in mind what has been gazetted in terms of tonnage, etc., maize, what has been gazetted is like 27% of annual import, of annual consumption, and rice is about 39% of annual consumption, and sugar is about 13% of annual consumption. So I'm making the point that this will actually have sort of a downward, will assert a downward pressure on prices, but more generally on food inflation, measured food inflation in the period ahead. So that's why the MPC ended up where we ended up in terms of policy. Let's move on to economic growth. And the economy has been resilient in 2022. And it grew by 5.6%. This is the chart that, or the table that we have been, discussing in the past. So you can see the column 2022 annual estimate at the bottom there is 5.6. And this has the 3 quarters, Q1, Q2, Q3, actuals, that's from KNBC. And Q4, we've really used the leading indicators. We've used all the leading indicators that we have. So we feel quite comfortable about the projection, the estimate of 5.6. we could talk about the specifics, but I think the only one I really want to point out is agriculture. Agriculture, as you can see, we expect that it will decline by 0.3%, so minus 0.3, so declining by 0.3%. And also in 2021, it declined by 0.2%. And so you can see these are 2 bad years in agriculture. And agriculture has therefore been being a drag. And we know why this is the case. It's really related to the dry conditions that we've been having, and obviously in parts of the country it has been drought. But the point is that our agriculture has therefore been sagging. Now, obviously back in 2018, it grew at 5.7%, and we do expect that there will be a rebound if we have normal conditions. So we are not hoping for floods and things like that, but having normal rainfall conditions in 2023, particularly the long rains. If the long rains are adequate, then we can most likely go back to where we were always. Maybe not back to the trend, but at least in terms of growth rates, a strengthening of this sector. Services obviously have been very important, and I think that's what the data shows that I'm presenting. Let's move on to the various, let's say, indicators, leading indicators, but I'll move very quickly on this. We'll circulate them when these slides are published, put out on our website, etc. So now just to show you that there has been continued, let's say, strong, the activities in the various sectors have remained strong. So here is wholesale and retail, and you can see the growth rates are still at 16%. Now we have November here, and we have incomplete December, so we didn't want to show the incomplete ones, but we've used that for our projections. So you can see that the turnover has really been strong, has been growing strongly. Also on manufacturing sector, which is the one on the right. Power consumption, this is more to a good indicator for what's going on in manufacturing. And you can see after the dip in August, and we know what happened in August, it was because of farms or productions being stopped in the context of the elections, etc. And you can see now this is recovering 4%, etc. Cement, there was a decline in June, July, August. And really this, we talked to the cement producers, etc. So this is turnover. But I think we also have the volumes. This is consumption and production. And you can see there's been that dip since mid-year. And they assess this as related to the decline, the completion of large projects. And we mentioned this last time, like the expressway, etc. But also some concerns about the payments that are getting to them, or rather are delayed, so pending bills, sort of things. But also they indicate that they are recovering well, and expect that they'll be back at a normal level sometime in February. So we expect that will flip over to the positive side as opposed to the decline early in 2023. Other sales turnover, storage, transport and accommodation, there they are. I'm not going to talk about them, but you can see the yellow line is way above all the others, but also the greens are positive, 16%, 30%, 20%, etc. Then we have private sector credit, which, as you can see, has grown by 12.5%. And I think some of you last time asked me whether where we expected it to be in December, and I think we are pretty much where we expected where we projected private sector credit growth to be. If you break this into the various sectors, you can see at least the 4 significant sectors: manufacturing, trade, transport, and consumer durables. You can see double-digit growth in all of them. And it indicates that there's a lot of, let's say, dynamism, private sector in those specific sectors. Okay, let's move now to the surveys. And I want to to mention just a couple of things on each of the surveys. And I encourage you to look at them in detail. They'll be published later this week, and long before Friday, hopefully by Thursday. And the point in the first one, which is the CEO survey, again, this is a survey of our CEOs, across the country. And you can see there's sustained optimism about business activity and growth. If you look, for instance, at the company level, and you are asking the CEOs, okay, at your company level, what is your perception? How confident are you, about the next 12 months? And if they are more confident, they're just as confident or less confident. So those are the numbers, and you can see already there's significant, if you add the higher and the same, you have something like 92% on the companies, and also on about their sector, they are but at 90% sort of level of either the same or optimistic. Why is this? I think the first one is that they appreciate or they acknowledge the focus of government on specific sectors, and underscore the resilience in the private sector. And this is something we've come back again and again and again. Kenya's resilience really anchored by the resilience of the private sector, and then of course other specific things in the particular farm that we questioned or that we surveyed. Now, the respondents were less concerned about the global recession, which is the same as I mentioned before. The general sense of impeding global recession has come down, and obviously also on inflation. Then on the other, this is the standard market perception survey, the second survey that we do. This one is a much older survey. And also this shows a lot of optimism. If you add the dark brown or dark yellow, I don't know, which shows optimism, with the blues, which is very optimistic. So you're talking something like 92% by banks. And on the other side, you're talking something like 85%. And I think all this, you can see there has been improvement between November and January. Again, the resilience of the private sector, they flagged that, the interventions by government, and the risks to this optimism, as the respondent indicated, is fiscal consolidation, and indeed the issue of the agricultural sector, which I think all of us now are much more susceptible to. We've had 2 years, or 2 bad years, and therefore those are like 4 rains, the short, the long, the short, the long, that have, in a sense, not been adequate. Moving along to the last of this is also on the market perception. This is an interesting slide when you're talking about forward bookings, right? And you can see there is a lot of significant bookings even through April, like 1/3, 30%. Mind you, this generally, as is indicated there, they generally are foreigners, meaning they are not Kenyans. Yes, around Christmas and Easter, Kenyans do book, but the ones that have this, that are indicated here, most of this forward booking really it relates to the foreigners that will be coming, which obviously will add further support to our balance of payments. There's business and conferencing that is taking place, particularly in Nairobi, etc., which also is supporting all this. I don't want to say too much about this, but I think it is something that you can look at in the CEO survey, in the surveys when they are put out. This is a survey, the agricultural sector survey that we've been doing, and I think this one indicates that respondents expect that there will be an increased volume of products, agricultural products in the markets, and they expect that to continue. We were asking them about next month, January and February. Remember, we did this survey in the first 2 weeks of January. And so they were responding with regard to what would happen the rest of January and also February. And all of them indicate that they expect increase in their output because of increased acreage and indeed also improved weather conditions. And in particular, they talked to us about the maize, rice, and wheat products which are being harvested, etc., as I indicated earlier. But this gave us confirmation of that general sense that we have. There is also the thing about cost, transport cost, etc., being a key factor in terms of affecting their retail prices, and obviously weather condition flagged as a major factor in the input cost. So I think I'll leave that there and ask you to look at the detailed survey. So let's move on then to the balance of payments. And the balance of payments, exports grew by 10.9%. This now we are talking the entire year, 2022. And tea obviously was a key driver there. You can see it there growing by 16%. Manufacturing also there growing by 22%. Coffee by 33%. And horticulture, related also to horticultural, the concern here was more the vegetable exports, etc., but declined due to high freight costs and also enforcement of minimum residual levels in the destination countries. So this is something that farmers need to deal with because, yes, it's not enough to produce the products, the vegetables, the flowers, whatever it is. You have to produce them according to certain standards, which I'm sure we've done before, and it's an issue of just ensuring that those standards are met. On imports, it increased by 8%, right? Imports relative to 2021, due to oil. And there in the chart you can see oil. Oil products grew, right, significantly by 60%. Yeah, 60% higher than 2021. But it is interesting, if you exclude oil, so imports excluding oil, it fell by 5%. And significantly, this is due to the to transport and transport equipment, which declined significantly by more than the amount of decline in all of non-oil exports. So I don't want to talk too much about this, but I think you can see the trends. But let's move to the next slide, please. Yeah, so here is the various imports excluding oil. Again, as I say, the dominant one in the intermediate is all those transport equipment, and all the other capital and consumer goods, you can see they have grown or relatively flat during the 2022 relative to 2021. I want to services. These are significant for our services exports, particularly transport receipts, if you may. because you have, for instance, all the long haulers, yeah, that send material. Kenya is very much a throughput, a lot of exports to, or rather imports to other countries, neighboring countries, will go through Kenya, the ports, the roads, etc. So transport receipts are significant, and travel receipts as well. These are the our personal things, etc., on travel, tourism, etc. Again, you can see it has been quite strong in this period. The other one to mention, well, this is the detailed numbers of tourists' arrival. Again, you can see the blues are now coming back to more normal levels, right? Obviously, we are still far away from the peak in 2029, right? But I think you can see we are now at more normal levels. Moving along, then we have diaspora remittances. This obviously was an all-time record, and you have it there. And it is important to appreciate that, yes, our citizens in the diaspora are supporting, not only do they support their families, etc., they're also supporting the country in particular ways. And we obviously are working to expand the ways in which they can bring back their earnings and remittances, etc. But this really has been a bright spot in our balance of payments, and I think this is something that we appreciate. Bottom line, the current account now is estimated at 4.9%. This really of GDP. This is against a projection of 5.9%, a deficit of 5.9% that we mentioned 2 months ago. So this sort of turnaround, as it were, in the current account, the strengthening, relates to some of the exports, etc., that we saw towards the end of the year. And I think this also compares to 2021 at 5.2%. So it's really a very good outcome. And it is something that I think one needs to dig at, just understand this a little better. But anyway, it is there, 4.9%. And we've mentioned before that our sweet spot in the current account is a deficit of about 5%. So I think we are there, and we expect that it will remain around there at 5.4% in 2023. This also means that the foreign exchange market will have greater stability, and I think we can begin by discussing what happened in 2022. And you have this chart, 2022. You can see that our currency depreciated against the US dollar by 9.1%. And relative to the others, you can see the dollar index strengthened by 7.9. Okay, I was trying to drink some water at that point. Okay, so thank you. So moving along, the foreign exchange market, there will be greater stability. And I think the 2022 outcome is there. We can move to the next slide, which is the few days in January. And you can see we've had a depreciation of 0.8%. And against all the other currencies, well, those are major currencies, but let's see what it is against our own currencies. So this is January to December against, compared to various other currencies in the region. And again, the 9.1 is what we had before. And then we have, again, 0.8% depreciation. So I think the point we have made before is we are very much in the middle of the road. And from that perspective, we expect to continue the policy, and we'll continue the policy that we have, which is a flexible exchange rate regime, and intervening when in cases of volatility or to minimize volatility, etc. A question about the foreign exchange cover. I think we have a chart there. It shows us that we are at about 3.9 months of import cover. And again, some of you have asked, okay, so is this adequate? Yes, it remains adequate. And really we have to accept, as we have, given the shocks that we have had, it's amazing the extent, the shock that all the countries around the world have had to sustain, have felt. And given this shock, given, for instance, that we couldn't go to the external markets, there were borrowings that we needed, that the government needed to do to support its budget, but did not happen. So the extent there was even a borrowing of about 1.1 billion US dollars that was programmed but could not take place because of the very adverse conditions in the external markets. So given all that, we accept lower reserve cover given the unfavorable conditions. But at the same time, we also are looking at it looking forward, which is expected inflows that will be coming, and we have this programmed in our into the future. World Bank, there's amounts like 400 million US, but that's programmed in June, but actually that number will likely be much higher. The IMF will be coming again for a review, and once that review is completed, long before end June, we expect 300 million US, the equivalent of that, and also other external loans that have been discussed. You've seen the documents of the budget, and they also talk about some external financing to that. So we don't expect, we don't have any concerns there. We do expect that the cover will increase, and the reserves that we are holding remain adequate for their purpose. Then a few more points to finish. The banking sector, well, on the government security, this is a graph that we have, but I think the one I really want to talk about is the time to maturity. You can see the time to maturity has been lengthening, and also the share of bonds to bills, that also has been, we've shifted quite well into the longer space that is on the longer dated securities. So having done all that, I think just a few points on the banking sector, which remains stable and resilient, and with liquidity, capital, etc. Important to note the NPL to gross loans has fallen to 13.3%. From December 13.8 in October. This is because of both repayments. There has been repayments in some specific sectors. As the economy has strengthened, the borrowers have found resources to repay and make those accounts whole again. There have also been some write-offs, but I think the dominant element is obviously the repayments. We expect further improvement in the business models of banks, really to leverage innovation, to leverage technology, etc. And as you can see, as we mentioned in the press release, the number of loan applications and approvals have increased. So this reflects improved demand, with the increased activity. Finally, there was a slide final slide on the government fiscal performance. We did discuss we did have a presentation on the fiscal performance, and I think the point here to make is that yes, there's a supplementary budget that is expected to be sent quite shortly to Parliament, and this has been discussed in various forms. There was public consultation about it just recently, etc. And so the expectation is that for 2022-23, that is the current fiscal year, the budget deficit will fall to 5.7%, and then we'll bring that down to 4.4% of GDP, and then keep it there. And this will, in effect, bring debt on a downward path, which is the single most important thing in terms of macro stability that ties everything. So, colleagues, I'll stop there and take your questions.
Thank you very much, Governor. And we shall begin the questions from Dominic Omondi. Dominic from the Business Daily is asking, are Remex, Multigate, Flutterwave, and Candon Technologies licensed payment service providers in Kenya? The other two questions are related. Actually, it's the same question from David Habling of Bloomberg News and Brian Gugi of the Standard newspaper. When is Safaricom due to complete the separation of M-Pesa business from the telecoms arm? You promised to give us an update in January. The way Brian puts it is Dr. Njoroge said earlier, a roadmap for the split of Kenya's telcos business units could be in place by January this year. Where are you with that framework?
Okay, fine, thank you. Dominic, I would encourage you to look at our website. It has a listing of all the payment service providers that are licensed in Kenya. So why don't you do that? It's there, it's public, easy to access. Also, just a freebie on this, there's also other digital service providers, digital credit providers, sorry, that we have also licensed, and that is also available on our website, and you can also see who is in that space today. On the separation, I would only say that this is ongoing, and I don't have anything, I don't have an update at this moment. It's true, I did promise that I would have an update around this time, but things don't always happen according to one's timelines. At times there are delays. So I do hope that a delay on this matter won't, will be okay on your space. So just be patient, I think. And then the last question is a roadmap. Again, all these things are in the works. But I think the point is it's not so much a roadmap, because actually there has been some telcos that have already done this. Yeah, and you can look at our website. They have press releases on the specific ones that have done this separation. And it is important. It is important for many reasons. You can see already, for instance, in the banking sector, there has been a good separation of the banking business from all the other businesses. So you have insurance, you have leasing operations, and all those are separated. And they could be under a holding company, and I think they've served well in terms of appreciating where the risks are, and also in terms of managing those risks and not having this sort of mixed up with the rest of the business or the rest of the businesses. Thank you.
All right. Next is from Brian again. Brian is asking, Brian Gugi from the Standard newspaper, what does the recent suspension of operations for a year by De La Rue mean for the country's currency needs and the Central Bank of Kenya? Back to David Habling from Bloomberg. 7 years after the collapse of Chase an Imperial Bank, depositors are yet to recover 100% of funds. Those responsible are yet to be punished. What are you doing to address this? Finally, from Dominic again, what happened to Safaricom's Faraja product, an interest-free loan facility for paying for services and buying goods? Was it approved?
Okay, fine. So I think in terms of the Deraru operations, they impact us only to the extent that we have, there are people that work in Kenya making those, supporting that industry, etc. But in terms of our currency needs are completely fulfilled, so we leave it as that. In terms of the second thing, 7 years after collapse, I think, David, you need to watch what's going on in this space. You should be able to write all the things that have happened. And as you know, a lot of these things have been in the judicial system. So we are not the ones who determine the outcomes of legal challenges, etc. So yes, I do understand that it has taken quite some time, and you may even say an inordinate amount of time. But I guess the point here is that we are struggling through the legal system like every other litigant, as it were. So just keep watching that space. I don't know about, Dominic, you're asking about a product, a Safaricom product. I think the best thing is you direct your question to the particular company that told you about this product.
From what we can see online, that is the last of the questions. So, as is usual, thank you for being with us. The MPC, as we said in the press release, is planning to meet again in March 2023, 2 months from now. But if there's any reason for the MPC to meet prior to that, you shall be let known in good time. So for now, thank you very much, and do have yourselves a good afternoon.